All right. Good morning, everybody. My name is Kerry Bubb. I am the president and founder of KWB Wealth. And with me today, I also have another Bubb, Rachel Bubb, happens to be my daughter and a wealth manager. She has her CFP and hopefully finishes up her MBA coming in the next 8 or 9 months from Berkeley. So today we're going to talk. Well, one thing I did notice today is we're all wearing black. So I don't know when we start talking about required minimum distributions, maybe it's the death of our IRAs or our deferred savings. I have another term for RMDs. It's reducing my deposits because whenever we have to start taking required minimum distributions, the IRS is seeing that we're starting to reduce the money in your IRA so that they can get the tax revenue and get us to spend the money and help spur the economy along. So, Rachel, let's start with what is or are RMDs?
Yeah, thanks. So RMDs aren't necessarily the reducing my deposits. They are actually titled required minimum distributions. So it is the amount of money that the IRS, like Kerry is saying, is requiring you to take from your qualified retirement plan. So this is all money that you have deferred over your working years. So it's all in those accounts that haven't been taxed before. So think about your IRA, your 401k, 403b, 457. Those will all have required minimum distributions. The other accounts like your Roth 401k or Roth IRA, those actually do not have required minimum distribution. So on that poll question, if you said no to Roth IRAs not having RMDs, then you are correct. And then who needs to take the required minimum distributions? So again, it's those that have an IRA or a qualified plan. You have to take money from them. And again, IRS wants their tax dollars. And then there's certain ages at when you have to start taking it. So it used to be 70 and a half. Now it used to be 72. There's been a lot of changes in the recent years, but just know that these dates are the things that you need to be looking out for. So if you were born before 1951, you should already be taking your required minimum distributions. If you were born between 1951 and 1959, your RMD age is now 73. If you were born in 1960 or later, the RMD age is actually now 75. And this is likely to change again in your lifetime because the government is changing that date of when they want you to start taking distributions because we're all living longer. So, with a longer life expectancy, they want to make sure that you still have money in that account. And we'll show in a life expectancy table, but they're projecting that you live till 90, and their goal is to have you liquidate most of that account by the time you hit 90. Now, that might not be the case anymore if people are living till 100. I know there's like studies out there that people be living to like 120. So they have to delay that age to make sure that you don't liquidate your account before you run out of time. And then there's one other rule, and it's the still working rule. So if you're 75 and you're still working, hopefully it's by choice and not by something else, but you can delay the required minimum distributions that you take from the employee plan or that employer plan of the company that you're working at. So let's say I'm 75, I'm working at KWB. I don't have to take required minimum distributions from my 401k because I'm still working at KWB. However, if I was a 5% owner, then I would have to take required minimum distribution. So there's that one caveat to it. And while that protects me in my RMDs and my that 401k plan at KWB, if I had an IRA outside of KWB, I would have to take RMDs from that. So I'm protected on the employer plan, but not necessarily on these other accounts that I have. Okay, so we talked about what they are, who has to take them. Let's talk about how they're calculated because that's also complicated.
Yeah, this sounds pretty simple so far. So RMDs are calculated annually, and they're based on two different factors. One is the value of your account and your life expectancy in that given year. So let's say we want to calculate our RMD for 2024 because you turned 73 this year. So what we would do is we would use the value of your IRA on December 31st of 2023, the year-end value, if you will, or the beginning value in 2024, and then we would divide it by your life expectancy. So we'll take you to the life expectancy chart, and we will show you that if you were 73, according to the IRS over there on the left column, you'll see distribution period. Your life expectancy is 26.5 years. So what we would do is we would take the value of your account, divide it by 26.5, and that's the amount of money that we have to take out, by the end of the year. Now, there is another caveat, and we'll show you an example, but if you turned 73 this year in 2024, you could actually delay your first RMD till April of next year. Now, if you did that, you would have to actually double up on your distributions. You'd have to take it for 24 and 25. But generally, after that, you always have to take your money out by the December 31st of every year. So we'll go back to that chart. We'll show or Rachel, if you want to pull up the example that we have.
Yeah, let me pull up our example.
And what we do here at the firm is we do a little worksheet for clients every year, because sometimes they have very simple situations where it might just be one IRA. Other times they have two or three different IRAs. So what we do is we take the IRA's value up there, and we might put 100, or let's say $1 million. And then we've got a 73-year-old person. So as you look down, that person is going to be required to take out $37,735 by the end of the year, or potentially by April the following year. That money will be taxed. We'll talk about that in a second. But let's say they had another IRA or two. Let's say they had another 500,000. Okay, so now the total IRA was 1,000,005. Now we have to take out 56,000 and some change. Now the IRS does give us the leeway to take the money from whichever account we want. So we could decide to take 50,000 from the $1 million account and 6,000 from the other. We could decide to take it all from the $1 million account. It doesn't matter which account we take it from. The rule is we just got to get it out by that December 31st of every year. And we have to aggregate all those values to come up with the amount that we have to take. So we're going to go to the next one. And how are they taxed? So IRAs are taxed as the money comes out as ordinary income. Ordinary income is kind of the worst kind of income you can have. It's taxed at the highest rates. It's not like long-term capital gains or qualifying dividends or even tax-free income. So every year when we take this money out, we're going to get a 1099-R, and that money is reported on your tax return, and that money will be taxed at whatever bracket you are in that given year.
And what happens if you forget to take your required minimum distribution?
Oh, you're going to get spanked by the IRS if you forget to take your money out. Yeah, they charge it's actually better now. It used to be a 50% excise penalty. Now it's 25%. To be honest, I haven't really seen them really enforce that rule too much, but you don't want to mess with the IRS. So make sure
you do miss it. So if you did miss it that year, they do give you a little bit of a grace period, and if you correct it within 2 years of the missed distribution date, the excise penalty is only 10%. So it's a little bit better.
Right. Yeah, and we've actually had clients in the past that have missed RMDs for many years. We don't really raise the attention to it. We kind of go in and take out the money and pay the taxes and move forward. And so far that's worked. But yeah, be diligent. Make sure we do your RMDs. Take them out every year. Calculate them correctly and whatnot. There's also a kind of a neat thing we can do with IRA distributions. So we have clients that have to pay quarterly estimates. It's kind of like when you get older, it's just one more thing to have to worry about, like writing a check every 3 months. And who wants to write a check to the IRS? So another thing we can do is we can actually do withholding out of IRA distributions. So for some clients, what we will do, let's say you're paying $2,000 a quarter for your estimates, we might go out and just withhold, 2 times 4 is $8,000 from your RMD, give it to the IRS, and now we can give it to them in December. We can make them wait for 11, 12 months before we give them the money, because when we do it through withholding, there isn't that quarterly requirement. So the big thing is we have to do some math. If you don't like paying quarterlies, if you have RMDs and we can do it, sometimes we can just make your life a little bit easier, and that's what it's all about.
This has been one of my favorite things that we've been able to do for clients, because it is really refreshing that they don't have to write. It's a relief, right? You don't have to make sure you make that payment to the IRS in April, June, September, whenever those payments come up. And I think it's awesome that you can make the government wait for their money and then not have to be penalized on the not meeting those estimates, because it's all done through withholdings. And then another really neat thing that you can do or strategy with the required minimum distributions, if you're charitable, are qualified charitable distributions. So these are QCDs, and this allows you, if you give to the church or to the local animal shelter, if you're doing that consistently and you're not really needing the required minimum distributions or you have enough income, obviously, to go do those, what we can actually do is send this your required minimum distribution any amount. It doesn't have to be the entire RMD. It could be 10% of the RMD or $5,000 of the RMD. But all we have to do is know who the charity is, and then we can send that money directly to that charity from the IRA. And the neat thing about this is now you don't have to claim that as ordinary income on your tax return. And this has helped a lot of people because in 2017, they made some tax law changes where it didn't really make sense to itemize for most people. And now a lot of us take that standard deduction. But now you at 70 and a half, so you don't even have to be RMD age to start doing this. You can do it at 70 and a half. You can start making donations and reduce your taxable income and not have to pay, or so that pretty much what you're getting is that tax deduction just in a different way. Now, a key thing about it is communicating with your tax preparer that you did this, because like Kerry had mentioned, you get a 1099-R at the end of the year showing you all the distributions that came out of or the money that came out of the IRA. It's not going to list that this one went to YAPS and this one went to the church. You have to let your preparer know that, hey, of my $10,000 distribution, five of that went to these charities. Yeah.
And the reason that happens is the custodian isn't going to police your charitable organizations. You can't say, well, Johnny Smith, my son, I've been helping him all his life. He's a charity. No, it has to be a publicly, Chapter C corporation, nonprofit, and you have to show that on the return. So the income is reported, then the taxable amount is reduced by the amount of money you give directly to the church or charity, and you can give all the way up to your RMD. So if you guys are charitable and you're over 70 and a half, the QCD is a very good way to get money to the charity. You win, the charity wins. It's a win-win-win, and the government gets less. Yeah.
Okay, so we've talked about individuals and your requirement distributions. Now there's this whole other thing for people that inherit IRAs and qualified plans. So I'm going to talk a little bit about RMDs for beneficiary IRAs. And there's a few, like you could be a spouse, a non-spouse beneficiary, and of course there are exceptions. So first, Bo, why don't you go to the next slide and we'll walk through this flow chart that we created to help us navigate all of the rules with a distribution with the RMDs for beneficiaries. So if you inherited an account and you had a beneficiary is designated on it, and then it's a spouse. So we'll go up to the top here, a spousal designated beneficiary. You have two options as that spouse of inheriting that IRA. We can do one thing where we open a spousal rollover IRA, and that means we move the money into your name. Or we could do something where we open up a spousal beneficiary inherited IRA. And each of these has different rules or like opportunities. So if you're over 59 and a half, moving the money into a spousal rollover IRA most likely that makes the most sense, because then you can stretch it out over your lifetime as a spouse. It's in your name, and you don't have to start those required minimum distributions until you reach that age. However, if you inherit an account before you're 59 and a half from a spouse, we sometimes like to put it in an inherited IRA, because then you have access to the money without having a penalty. So as you all know about some of your retirement accounts today, you can't access them until you're 59 and a half without paying some sort of penalty on the distribution. By leaving it in an inherited IRA, that spouse can access the capital of the trust, or excuse me, the capital of the account, and not have to pay that 10% penalty that would be on it for an early distribution. So that's for a spouse. Then what if you inherit it as a non-spouse? So there is this new rule that came out that you have 10 years to liquidate the account. And they just changed it again that you don't actually have to have any RMDs on this unless the person that you inherited the account from was already taking RMDs. So if the person that you inherited, like Kerry gives it to me, he's already taking distributions, I have to continue those distributions. And if he didn't take it in the year that he died, I have to take it in that year and then make sure to continue it on. Now, my RMDs are calculated based on my life expectancy, but I still have to take them and I have to liquidate the account within 10 years. Okay, the other option and is if Kerry and I were not actually, father daughter and maybe we have 10 years apart between us. So if I'm 10 years from Kerry's age, then we get to get rid of this 10-year liquidation rule. And now I can take out the money from the IRA over my life expectancy. So I don't have to do I do have to do RMDs once I inherited the account, and it has to be done at least in the year following the death. But at least I can stretch it out over my lifetime. I don't have this 10-year liquidation rule. I would think the worst thing that happens is if someone didn't designate a beneficiary, and then it goes to the person's estate, and then that estate has to liquidate the asset within 5 years. Do you
Yeah,
want to
and
add
it's so
something to that?
easy to it is so easy to name a beneficiary, but you know what? From time to time, we've run across clients or their families that the father died and didn't have a beneficiary.
Yeah.
So make sure you're dotting your I's and crossing your T's, and you're dealing and making the appropriate designations for your estate for
And we
sure.
also had a few times this year, we've had spouses die pretty, and sadly, like really closely to each other that we didn't have time to move the assets into the other person's name before the next death. And that's also created a little bit of that's something that's really hard to time and not much we can do too about that. But we just want to make sure that we're looking at your accounts and having those beneficiaries designated. And you might say, like, for some clients, I know they don't really care. Like, I'm not going to be here. What does it matter? Well, I just would encourage you to think about the people
Yeah.
that are going to have to deal with it when you're gone. And you worked hard for that money. Do you want the government to have it, or would you rather a charity or someone that was a friend have it? I think just trying to make sure that the most of what you worked for gets passed on to the people or the cause that you want it to go to. And then,
And
oh, good.
when you're not, a spouse and you're an aunt, an uncle, a son, a friend, or whatever, and you get these IRAs from maybe someone that cared about you, gets a little bit more tricky. And my guess is over the next 5 or 10 more years, the laws are going to keep changing. So I guess do some research. We don't want to dwell on this too much because most of the time it's husband and wife, and then obviously the children. We just want to make sure we have it the best manageable, mitigate taxes, mitigate probate, and it makes the most amount of sense that we can for you. So,
And hold on, before you move into the next thing, Roth IRAs, Roth 401ks, even if you inherit it, they don't have an RMD as well, but you do have to liquidate it within that 10 years. So that's just
right,
that 10-year rule is pretty much sticking. And the reason that they did that is they wanted to the IRS doesn't want to keep stretching out all these IRAs through different generations. They want to get that money.
well, and I think they also think, hey, that was your father's money. That was your uncle's money. That was his retirement. We're not going to let you take it out over the next 40 years. We want our revenue. Or if it's a Roth, we want you to take it out and have to spend it or reinvest it where potentially there are taxes being generated. So let's talk about some of the takeaways. And we didn't really talk about Roths much, but I do want to say Roth conversions. So Roth conversions are something I really, really believe in. And this is when we try to get ahead of maybe what might be happening to us as we become 73 or 75. So a lot of times, maybe people retire at 63 or 5 or whatever, and maybe they don't need all the money from their accounts. So sometimes what we will do is we will maybe get ahead of it by taking some of the money in the IRA and converting it to a Roth. The negative is we have to pay the tax now. The benefit, though, is anything that is in the Roth after we get it there gets to grow tax-free for the rest of your life, gets to pass tax-free to your kids, and it potentially, depending on how the accounts do, it potentially reduces the RMDs in the future. So here, what we're trying to do is really just manage the tax situation, and that's down below. So Roth conversions, boy, we usually try to talk to everybody about it. We encourage it. I embrace it. Those are something that you definitely want to do.
Yeah, and in our planning software, it's really cool that we can see how much wiggle room we have within your current tax bracket to because you're going to be in the maybe you're always going to be in the 22. So what is the gap that we have between the 22 and the 24 that we can take advantage of and start to slowly move money over into the Roth account over your lifetime? And for some people it actually saves them quite a bit of money in taxes over their lifetime. For others it doesn't. Again, it's really dependent on your situation, but at least we can start planning for that. And the sooner we talk about it, even before RMD age, the better. But there are still some strategies once you're in RMD age to evaluate your tax situation and take advantage of this. And then we talked about it, but qualified charitable distributions. I think if that is something that you are already doing, let us know and let's help you do. Or if you're not doing the qualified charitable distributions, but you're giving to charity, let us know so we can help you figure out how to do that more effectively.
Yeah.
And then lastly, I would say is the consolidating accounts is something that we encourage you to consider. I know like people keep different accounts at different places, whether it's to diversify their basket or, not put all their eggs in one basket. But sometimes it can be really complicated when you've got 3 plans out there and you've reached RMD age, and now you have to make sure that you've hit that required minimum distribution from each one. And what's great about an IRA is you have flexibility within how much you can withhold for taxes. If you have a 457 or a 401k out there and you're in the RMD age and you're going to be taking those distributions, they have a mandatory withholding of 20% for federal taxes. So you can't even be flexible on the distribution and how much you take in terms of taxes. So you might be over withholding or even under withholding. We don't know, but you just lose that flexibility. So by consolidating, brings it all together and it just makes it easier for you to make sure you hit that RMD.
And I think just the one last thing is, we are encouraged when we're young, or our parents encourage, hey, put money in your 401k, take advantage of that. And I certainly agree with that because of the tax deferral and whatnot. I don't necessarily agree with maybe just pushing or kicking the can down the road as far as we can, waiting till we're 73, waiting till we're 75. I think there are some practical things that we can do, just to help manage that tax bracket. And every situation is unique. If you got a great pension and a great retirement and your tax bracket's never going to go down, well, is it still best just to kick the can down the road? Or, hey, maybe I just go ahead and pay the tax now. So at least from here on, things will go tax free. And the reason you would consider that is if you believe taxes might go up, then it might be better to convert sooner. If you believe taxes are going to go down, then you probably wouldn't want to convert. I think we had a question here in our poll is, do you think taxes are going up or down? So we'll see what everybody says there. But Bella, we'll open it up to questions. Are there any questions or any other things that we need to address?
We've got a few questions. Rachel, do you want to go through them?
Yeah. So first,
how about our poll questions first? Can we do that?
Okay.
Sure. Let me pull those up.
Okay. So about 22% of the people learned today that if they have their own Roth IRA, they do not have to take RMDs. And that's good. And do you believe tax rates will be higher or lower in the future? Okay, 92% of you, majority believe they're going to be higher. So that's another reason why maybe just kicking the tax IRA thing down the road isn't maybe as good as we used to think it was. Interesting. Good. All right, questions, Rachel?
Yeah, so the first question, if we take a lump sum at the time of our retirement, so I think this was specifically talking about the SCE, like the Southern California Edison Cash Balance Plan. If we take a lump sum at the time of retirement, does that help how much we have to take at 70 plus age?
So the answer to that, if you take a lump sum and you keep the money, then you're going to pay all the taxes on it all at one time. If you take the lump sum and you move it into an IRA, then when you're 73 or 5, depending on the situation, you will be taking RMDs at that point. Now, sometimes people need the money. So let's say my $1 million example, I think we went back, it was like $36,000 a year. Well, let's say you needed $3,000 a month to live on. So if you were taking $3,000 a month to live on, which is $36,000, and your RMD was $36,000, well, you're already satisfying the RMD. So it really depends on the situation as far as your living expenses, your needs. The last thing you'd want to do, though, is take that lump sum and put it in your bank account and lose all that capital. Yeah.
Yeah, because now you've paid taxes on it, so all of a sudden you've reduced the amount of money that you have to invest. And then that money that's growing, hopefully you keep earning money on that money, and then it's treated at capital gains rate, which is more favorable, at least at this point, than ordinary income. But you're now being it's just being
No,
taxed
yeah, well,
twice.
and you're
It doesn't,
losing 40 to 45%
yeah,
right off the top.
yeah.
You don't want to do, I mean, there's
It's
very
not the
rare
best way to avoid RMDs. There's
Right.
other options.
Yeah.
Or
The
reduce
RMDs
your
aren't bad.
RMD.
It just,
Yeah.
it means that you've saved money. You've been diligent. These are good problems to have. Right.
Yeah.
Okay. Number 2.
Does the working rule apply to full-time and part-time work?
Yes, it does. As long as you're not a 5% or more owner of the company, or if you're self-employed, then you're 100% owner, right? But if you're not an owner, or I'm sorry, if you're less than 5%, it does apply part and full-time. But again, only to that retirement account. You still have to address your IRAs if you have separate assets out there.
Next question. Did you say our accountant or IRS does or does not need to know who QCDs go to? Go ahead.
Go ahead. You go ahead.
So the IRS doesn't necessarily need to know. What happens is your accountant needs to know that you did that, because when they get the 1099-R from LPL, for example, they don't know, it's not listed on there that 10,000 went to YAPS, 10,000 went to the church of, blah, blah, blah. They just see that there was a distribution. So you have to let your accountant know that here is the line item of all the places that my money went to. And I think they do attach that to the return.
Well, and a lot of times too, the charity will send back something too, that acknowledges your charitable contribution, which would then match up with your tax return, down the road. Right.
And then Tom, yes, we can. Tom, you would like your beneficiary paperwork. We'll look into that for you and we'll get back to you. Okay. Next question. If you give an RMD to charity, are taxes paid by the charity, or are taxes paid at all?
No taxes at all. No tax by you, no tax to the charity, 100% tax free.
Can you use a portion of your RMD to convert directly to a Roth? Does that count as your distribution or
No. So if you have to take 36,000 and you want to convert, you still have to take the 36,000, and then you could convert 10 or 20 or whatever amount. That's why getting ahead of this before RMD age can be very, beneficial.
Yeah. If you don't need your RMD, what about reinvesting versus doing a Roth?
Well, if you don't need your RMD, you can't do a Roth unless you're still working and there's something else going on. Then absolutely you can reinvest it. And then we want to try to be as tax efficient for you going forward, because now whatever you took out of the RMD and we invest, the earnings from that would be subject to tax. So we want to be cognizant of that, and depending on your bracket and your situation, try to be tax efficient.
Okay.
A lot of questions.
I know this is a hot topic. I'm trying to think. Some of these we might just reach out to you independently to answer. Markets fluctuate during the RMD distribution year. Is there a best time during the year to take the RMD? And is this something you may notify your clients about?
Yeah, so I think it kind of depends a little bit. The other day, we were visiting with a client and got some pretty big RMDs. And so what we've decided to do is take the money out at the beginning of the year so that we don't let the IRA have a chance more to grow, which creates even bigger RMDs in the future. I think the best time to take it out, obviously, is when the market is high. We don't know when that will be because, well, the markets are just too volatile. Generally, though, like when Roth conversions, we talk with clients about Roth conversions. I usually say, convert early. Early is better. You look at this year, the market's up 20%. Well, you should have converted in January, because then all those earnings would have accumulated tax-free since January 1st to October the 9th. So Roth conversions, though, the best time to convert is when the markets are down, because we can move more shares for the same taxable event. But when you're actually taking money out RMD wise, it's probably better to do it when the markets are high, And then I think it depends on individual circumstances. Do you do it at the end of the year? Do you do it at the beginning of the year? Those things are more individual.
You had one more question, but about the QCDs. And an accountant said that he didn't need a specific distribution list for the QCDs, and she's wondering if he is wrong.
So maybe I think what is happening maybe you made 6 different gifts to 6 different charities. You should provide him a list of, hey, I gave 2,000 to the animal shelter. I gave 4,000 to my church. Yes, I think you should do that.
Probably best practice. He might not need to file it, but it's probably best practice.
Right.
Okay, and then last one. Do you recommend Roth conversions for those who don't have children?
I recommend Roth conversions for people that have wealth that they don't need currently to live on. I recommend it to people that can benefit because of time, depending where you are as far as age. I am a guy that likes to pay the devil I know versus the devil I don't. So I know where taxes are now. I'd rather pay it, get it over with, and have it tax-free for me. Because then if I woke up one day and I want to buy a boat or an RV, now the money's clean, So again, I wouldn't go out and convert everything if it pushes me into the 24 or the 30 or the 37% bracket, but try to manage, all of those things. But yes, I'm a big advocate of the Roth IRA.
I
Single,
think even
married.
even if you don't have children, what's nicer then is if you do some conversions over time, then you have three buckets of money to choose from. You've got money that you can take at any time in that Roth IRA that you don't have to pay any taxes on. Then
Right.
you have money in a non-retirement account that maybe you pay capital gains on. And then you have the IRA where you'd have to pay ordinary income. So when we have those three buckets, that gives us the flexibility to make decisions for you of where to pull money for that next goal that you have or that adventure, what have you. I just think it provides more freedom, flexible choice,
Yeah,
all of those things that are going to lead to a better quality of life. Yeah.
absolutely.
Okay, last question, and then we'll wrap it up here. How does the RMD compare that percent wise to the 4% withdrawal rate rule?
Early on in your life, when you turn 73 or 75, it's probably about 4%-ish, 4.5%. When you get to be in the life expectancy chart, now all of a sudden you're 90, you have to take your divisor is 12, right? So now you're probably pushing 7 or 8%.
Yeah, it does the percent gets higher as you get closer
Right.
to the end of your life.
That's right.
Yeah.
Yeah. So, early on, the IRS is kind of looking at your life, stretching it out. And every year you get older, you're going to live less. And so I think at 120, your life expectancy is 2 years. So they'll never make you pull it all out because when you're 121, it's probably, 1.7 years. But generally in the early stages, yes, the 4% rule pretty much is consistent with the RMD tables. But then as you get to be 80, 90, yeah, now all of a sudden you're doing 6, 7, 8% out of your portfolio. And you're depleting capital. And that's what they want.
Well, thank you so much, everybody, for your time. Bella, why don't you pull up on that last slide? And if anybody has questions that we didn't answer here today, please reach out to us at Invest or contact your advisor. If you want to see some things in the plan, let us know. We hope you enjoyed this. It was really fun to talk about, and it is a complicated subject. I think there's a lot of new rules that make it more interesting. And our job here at KWB is just to make sure that you're meeting your requirement distributions. We're doing everything efficiently and helping you plan and meet those goals. So
All
thanks.
right. Have a great day. Happy Halloween, everybody.